Welcome to today's What Will Move the Market show. I'm your host Prem. It's Monday, February 9th, 2026, and here is everything you need to know as the markets open for today. Overnight cues are actually from Friday's action on Wall Street because the US markets were closed over the weekend. On Friday, US equities staged a powerful rebound, with the Dow Jones Industrial Average closing above the historic 50,000 mark for the first time ever, ending near 50,115, up about 2.5% on the day. The S&P 500 finished around 6,932, up just under 2%, and the Nasdaq Composite closed near 23,031, higher by a little more than 2%. The rally was led by a sharp comeback in technology and AI-linked semiconductor names. Chip giant Nvidia jumped roughly 8%, Broadcom surged more than 7%, and the broader semiconductor basket was up strongly. At the index level, the small-cap Russell 2000 also gained more than 3%, signaling a broad risk-on mood rather than just a mega-cap move. Offsetting that strength, Amazon was a big drag, falling around 5% on Friday as investors reacted nervously to its plan to spend about $200 billion this year on artificial intelligence and related infrastructure. Stellantis was another notable loser, tumbling by around 25% after flagging a massive charge tied to a strategic rethink of its electric vehicle push. The macro backdrop behind this rally remains supportive. The Federal Reserve left rates unchanged earlier in the week and continues to signal patience. US data like consumer sentiment has surprised on the upside, and markets are still pricing in the possibility of rate cuts later in the year. Politically, President Trump was quick to celebrate the Dow's move through 50,000 on social media, reinforcing the narrative of a resilient US economy. In after-hours trade, attention stayed on Amazon, where that huge AI capex guidance kept the stock under pressure, while traders continued to focus on AI spending versus profitability across big tech. For Indian investors looking at US-listed India exposure, the Indian ADR pack sent a moderately positive signal on Friday night. Infosys ADR inched up to about $16.84, a small gain of roughly 0.2%, suggesting some stabilization after recent IT underperformance. HDFC Bank's ADR did better, closing near $34.46, up about 1.4%, as investors reacted positively to both domestic policy clarity and strong banking fundamentals. ICICI Bank's ADR also firmed up, ending around $31.18, roughly 1% higher, continuing its steady outperformance among Indian financials. Reliance's overseas listing was mildly positive too, with its global depository receipt in London finishing close to $64.40, up just under 1% for the session. Overall, the overnight ADR picture points to a constructive bias for large private banks and a more measured tone for IT and energy as India comes into trade. Turning to Asia, remember that as of our recording before 8 a.m. India time, the major Asian cash markets have not yet opened for Monday, so the reference points are Friday's closes. On Friday, Japan's Nikkei 225 closed strong, just above 54,250, up close to 1%, with autos like Toyota gaining after management changes and tech sharing in the global rebound. Hong Kong's Hang Seng Index, by contrast, ended under pressure around 26,560, down a little more than 1%, as persistent concerns around Chinese growth, property stress, and tech regulation kept investors cautious. The Shanghai Composite closed near 4,066, modestly lower by about 0.25%, reflecting that same cautious tone despite ongoing policy support from Beijing. As of the latest available data this morning, GIFT Nifty futures are hovering around the mid-24,000s, roughly 60 points above their previous close, pointing to a flat to mildly positive start for the Nifty 50 rather than an aggressive gap up. From across Asia, there are no fresh holiday-related closures today in the major indices, but sentiment in the region is being shaped by the combination of Friday night's powerful Wall Street rally, softer global rate expectations, and still fragile confidence in Chinese equities. On the global macro and geopolitical side, two big pieces matter for sentiment as we start the week. First, both the European Central Bank and the Bank of England left interest rates unchanged last week. The ECB kept its key rate steady, with the deposit rate near 2%, reiterating that inflation is moving back towards target and that decisions will remain data-dependent. The Bank of England also held its policy rate around 3.75%, but in a very close vote with several members already backing a cut. Markets read this as confirmation that the next global central bank move is more likely to be down than up, which supports risk assets and is positive for emerging markets like India. Second, the big structural story for India is trade. The new interim India-US trade agreement is now in effect, with the US slashing punitive tariffs on Indian goods from around 50% down to roughly 18% on average, and removing duties entirely on key items like generic medicines, gems and diamonds, and some aircraft components. India, in turn, has signaled a commitment to purchase about $500 billion of US goods over the next 5 years. For markets, this improves the medium-term outlook for Indian exporters in sectors like pharma, textiles, engineering and specialty chemicals, and it underpins the recent outperformance in export-oriented themes. In commodities, Brent crude closed on Friday near $68.05 a barrel, up about 0.7% on the day but still well below peaks seen last year, as worries about potential supply disruptions around Iran and the Straits of Hormuz are being balanced by oversupply and softer demand. Copper, a useful gauge of global growth, ended the week around $5.88 a pound, up just over 1% and not far from its recent record highs, signaling that industrial demand remains resilient. The real fireworks, though, were in precious metals. International gold prices have spiked to about $4,960.72 an ounce, up more than 5% on Saturday's close alone, while silver has surged to roughly $77.72 an ounce, gaining over 13%. That kind of back-to-back strength in gold and silver reflects a mix of safe haven demand, expectations of lower real rates, and some short covering, and it is supportive for Indian jewelry exporters and bullion-linked plays, but could also add to volatility in metals and mining names. Back home, Indian equities ended Friday on a constructive note after a volatile week driven by the Reserve Bank of India's policy decision and the new trade deal headlines. The Nifty 50 closed around 25,694, up about 51 points, or 0.20%, while the Sensex settled near 83,580, gaining roughly 266 points, or 0.32%. Bank Nifty finished close to 60,121, up a modest 57 points. The RBI kept the repo rate unchanged at 5.25% with a neutral stance, broadly in line with expectations, but the quality of the communication was market-friendly. Governor Sanjay Malhotra emphasized that inflation is manageable, liquidity will be kept ample but not excessive, and growth remains reasonably well supported. Importantly for sectors, the RBI proposed allowing banks to lend directly to listed real estate investment trusts, which is a structural positive for both REITs and their sponsor developers, and it doubled the limit for collateral-free MSME loans from 10 lakh rupees to 20 lakh rupees, which supports smaller borrowers and lenders focused on that segment. On Friday, domestic price action reflected this mix. FMCG and private banks led the gains, with stocks like ITC and leading lenders seeing strong buying, while IT remained an underperformer despite the global tech rebound. On the flows side, foreign institutional investors were net buyers to the tune of roughly 1,950 crore, while domestic institutions took some money off the table, with net sales of around 1,265 crore. So FIIs have come back on the buy side, just as RBI and global central banks signal an extended pause. Primary markets will also be in focus today, with two mainboard IPOs opening for subscription. Fractal Analytics, a global AI-driven analytics player, and iFinance, a retail and MSME-focused lender. Combined with several SME issues already in the market, that means some domestic liquidity will get absorbed by the primary market over the next few sessions. One important regulatory backdrop to keep in mind is SEBI's ongoing tightening of F&O rules. New norms are steadily being implemented to align derivatives more closely with cash market liquidity, cap outsized intraday exposures, and improve risk disclosures. That includes stricter market-wide position limits and entity-level caps, tougher eligibility criteria for which stocks can remain in the F&O segment, and more granular intraday margin monitoring. Practically, it means leverage intraday strategies, especially in options, need to be sized more conservatively, and traders should expect more frequent surveillance-driven margin swings, particularly around expiry. Coming to today's technical picture, Nifty starts the session after defending key supports on Friday. Immediate support now lies in the band between about 25,560 and 25,489. As long as this zone holds on intraday dips, the short-term bias stays mildly positive, with deeper support sitting closer to 25,200 if volatility spikes. On the upside, the first resistance is clustered near 25,760, followed by a heavier supply zone between roughly 25,800 and the big psychological number at 26,000. A sustained break and close above that band would confirm that bulls are regaining full control after the recent consolidation. For Bank Nifty, immediate support is seen around 59,800, where buyers stepped in on Friday, while resistance is placed near 60,400, just below its recent all-time highs. Any decisive move beyond either side of this range is likely to set the tone for sector leadership in the coming days, so watch how banks behave on intraday pullbacks and spikes, rather than just the headline index. Putting all of this together into a day plan, the overarching theme for Monday is optimism with guardrails. Globally, risk sentiment is buoyant after the Dow's milestone move and strong US close. Central banks in the West are on hold with a tilt towards eventual cuts, and the new India-US trade deal is a genuine tailwind for exporters. Domestically, RBI has delivered a steady hand message while offering targeted support to real estate and MSMEs. FIIs have turned net buyers again, and earnings season is rewarding quality franchises. At the same time, valuations on the headline indices are rich, precious metals and some commodities are swinging sharply, and SEBI's stricter F&O regime is changing the intraday trading landscape. For traders, that argues for respecting levels, not emotions. Avoid chasing large gap moves at the open, be disciplined about position sizing and leverage, especially in options, and let the 25,500 to 25,800 band on Nifty and the 59,800 to 60,400 corridor on Bank Nifty guide your intraday risk. For investors, the message is to stay anchored to long-term themes like financials, consumption, formal real estate, and export competitiveness, rather than getting carried away by short-term excitement around AI or metal spikes. And through the day, keep an eye on how global commodity prices and US futures behave, because any reversal there can quickly feed into sentiment here. That's all for this morning's edition of What Will Move the Market. Trade safe, stay curious, and keep your risk under control. Stay tuned for the evening wrap. Send in your questions and subscribe to this podcast to hear US every day.